Good morning. I'm Ian Whittaker. I'm Director of Liberty Sky Advisors. I was a city analyst covering the media and digital sector for 20 years. I've been twice Analyst of the Year. And I just thought I would share my thoughts on advertising and the global pandession and what to expect moving forward. So I'll be talking about macro trends, advertising, and then also as well what we see happening in what I'd like to call the sort of broadcasting video space. If you start off with the macro themes, I think the first key point to say is we don't know where we are in terms of the pandemic and what happened, and things can change very quickly. Now, this and the next slides are from Informa. Informa is the largest global events operator. They are in many countries. What I like about events is they give a very good insight into a number of macro trends. Essentially, events are key for many businesses to sell their products. Also, as well, you get a mixture of domestic exhibitors and international exhibitors, and the international ones, of course, have to travel. So it's a good indicator of business travel as well. And overall, it tends to be gives you a good impression of what's happening with the economy, but also as well, what's happening in terms of travel trends and so forth. Now, this was from in June, of Informa then, when they updated the market, expected that essentially events would be back to normal pretty much from October and November. In their most recent update, which was at the actual end of last month, what you can see there is that essentially international exhibitors have just it's not happening this year. China is really the only market where things have gone back to relative normal situation. And even there, there were no international visitors which coming in. And what this is telling you is that essentially in terms of the global economy, that it has been disrupted on a worldwide basis. And that in fact, actually, if anything from 3 months ago, people are probably a little bit more pessimistic as to when things will return back to normal. Now, the second point would say is that there's definitely some improvements in tone that are coming through. These are new forecasts that have come out from the IMF, and what they showed, they're just literally from last week, showed there's an improvement in the 2020 global GDP expectations. So it is positive there's been an upward revision. And certainly when you look at the stock markets, particularly in the US, are expecting things to bounce back relatively quickly. Stock market performance has been very good there. In China, it's actually been better. A lot of this is driven by the tech stocks. If you look at the old economy names, and they tend to react pretty much similar to what you could see with the FTSE, which is the blue line at the bottom. FTSE is very much old economy in its composition. It really has very few tech stocks. And since a initial bit of a bounce back post the trough, it hasn't really done that much. If you then go on to what we're likely to see, well, China's likely to be the outperformer when you look at the markets. These again are from the IMF forecast. You can see there that China is really the only market that's expected to show growth of the major economies. The right-hand side, what it shows is of a mixture of economies, really based on what was the expectation going into 2020 and what the IMF is thinking now in terms of global economic growth. And what you can see there, the dotted line is previous expectations. The solid lines are where we are now, both for the advanced economies, which are in blue, and also as well for developing markets, which is the green, ex-China. You can see there's actually been a lowering of expectations, and really these economies will be smaller in 2021 than they were in 2019. And one point to emphasize here is not everyone is impacted equally. That goes for businesses. It also goes for consumers as well. This is a map of the US, just looking at the change in employment data. What you can see there is really the variation amongst states. So there's a huge difference there in terms of what we're seeing. And again, this will reflect the composition of employment within those various states and what people do. As you've seen from business results, some have done very well, for example, particularly in tech. Some in retail have done pretty badly. What we do expect, though, is we do expect a permanent reduction in the economy due to pandemic. Now, the IMF, in its most recent forecast, estimate that there's been a permanent loss of around $28 trillion to the global economy. The right-hand side here is looking at the UK in particular. it's looking at real private consumption. And what you can see there is that even in the forecast from the Office of Budget Responsibility in the upside scenario, realistically, it doesn't get back to pre-pandemic forecasts until the first quarter of 2025. Now, for many firms, another point to say is this is going to be very much of a cost-led recovery. That's to be expected. We don't know what's going to happen with sort of the economy, and so many firms are taking the view that it's better to be cautious. This is from the Deloitte survey of CFOs in the UK, but if you were to survey CFOs in most global economies, you would expect to see the same sorts of trends. The emphasis there is very much on reducing costs and increasing cash flow, and also as well to strengthen the balance sheet. So nobody at the moment, or very few people, are really thinking about this in terms of sort of this top line is going to recover anytime soon. When it comes to the consumer, there's the obvious issue here of employment and what happens with cyclical issues when it comes to jobs, but there's also a structural issue here as well, in that many firms have actually taken this crisis as an opportunity to delayer their workforces, to bring in new working practices that essentially favour the employer over the employee. And you also have the growing issue here globally of automation of jobs, which threatens to unleash a new wave of job cuts over the medium term. Now, in terms of this can really sort of fit sort of within both macro trends and also as well sort of advertising. But I think it's worth emphasizing here on e-commerce, which of course is of increasing importance. But Amazon may not win the e-commerce race. Many people think so. But one thing this pandemic has done is actually made e-commerce a center for many ordinary retailers' strategy, as opposed to sort of peripheral part of growing as it were before the pandemic. Now, if you look at online sales growth for many retailers, what you'll actually see on the right-hand side is that Amazon is actually at the bottom of the growth rate. Yes, it is much larger than many of these companies in terms of online sales. Amazon has around a third, just over a third of the US e-commerce market. But you can see that many of these retailers are catching up. And in fact, sort of the comments that have come from retailers is that having a physical store is actually a great advantage in driving online sales. And that's obviously something that Amazon doesn't have. Now, look at the sort of trends within advertising here. So actually, one point to say is that advertising has held up remarkably well. Typically, advertising follows GDP. That's no great surprise. Advertising is intangible CapEx. Yeah, essentially, when you look at it, just as firms invest in physical plant, they invest in advertising in order to grow their brands. What you can see in Q2 is that actually advertising, which is atypical for a recession, actually performed better than the decline in GDP. And we're already starting to see comments coming through in the third quarter that advertising should be better in Q2, and indeed that trend should continue moving forwards. Now, sort of going into 2021, the expectation is of a rebound. These are the Group M global advertising or the US advertising forecasts. There, what you can see is a sharp rebound. Bear in mind that 2020 does benefit from US political ad spending. You take that out, Group M is forecasting at nearly a 9% rise when it comes to US advertising forecasts. So a pretty sharp rebound, but of course we've had sort of 2020 been quite a sort of sharp decline as well. But also as well, there's some structural benefits sort of for advertising. That means it actually may sort of recover more powerfully longer term than expected. One thing to say is that you will get more firms sort of being created, the sort of creative destructionism, and particularly direct-to-consumer firms becoming more important. The second point to emphasize, and this is something that Mondelez say, is that there may be a structural shift of money to go from companies going from areas such as travel and property, which actually should see a structural decline because of the changes in working patterns, and that money being moved into advertising, able to help support brands. But also as well, another area that brands are likely to have to spend more on because of, and particularly here you're looking at the FMCG groups, is because of the shift into e-commerce and sort of this idea here of Q-commerce, which is this idea that essentially a very small created number of brands are sort of advertised to consumers. Now, the point is here that effectively, if you do get a move to e-commerce and Q-commerce, what it's likely to mean is that there's likely to be a greater sort of power of the retailer or the Q-commerce provider to sort of promote certain brands over others. And so it becomes increasingly important for brands to be known and recognized by consumers in order that those brands are wanted by consumers, so that retailers and Q-commerce providers actually have to shop them. And this will be an increasing importance moving forwards. Another thing to emphasize, and it goes back to this point before, that sort of many companies are really hunkering down on costs, but being increasing intolerance of waste. Yeah, this is the chart that I'm sure many of you know from ISBA and PwC, talking about the potential waste in programmatic advertising spend. So on digital, sort of in the past that has been tolerated, in the future that's unlikely to have lost the shareholder value that comes from this sort of wastage. Advertisers will no longer be willing to accept that nearly half their money is wasted in the advertising pot, and that will have implications particularly for ad tech. The final point to say in terms of the general advertising market is that what also brand advertising may benefit from is a shift of money coming from other areas. And one thing to look particularly here for is paid search. Paid search is the new version of the old Yellow Pages business. Now, Yellow Pages, the classified directories, they definitely had their role, but they were never seen as brand building tools. And what's happened here is there's been an explosion of paid search globally that quite frankly has meant that paid search is taking up too much of advertisers' budgets. And what I think is that essentially this over time will start to decline as advertisers realize, just like Adidas did, that essentially paid search is really too much of their budget and it doesn't really contribute to overall sales. But what really is important is actually the need to spend on brand. Now, just looking at television and sort of thinking about this, my view of television is that essentially the view of television as linear TV is increasingly an outdated fashion. The way to look at broadcasters is very much an all-encompassing video. In fact, the phrase that we use is total video. The first point to make here, though, is I think the broadcasters really do dominate the video advertising day. This is from the UK. It looks at a variety of data. And what you can see there is that because many people sort of go through ads very quickly in terms of YouTube and Facebook, when it comes to pure advertising, the amount of adverts that people see, then broadcasting sort of very much dominates the pie, even for 16 to 34-year-olds. So the broadcasters' platforms definitely remain a very important medium. But also as well here, what you have is that you're seeing this shift here from linear TV to what, as I said before, was this total video idea. If you look at streaming in the US, streaming is now 25% of total usage of TV in streaming capable homes. Netflix has a third of that, but also as well, you've got Hulu and Amazon and Disney Plus that also have quite noticeable shares within there. And what this will lead to, I think, is sort of an increasing emphasis on the streaming part. And this is an important point because if you look for Netflix, which of course is the leader, a third in the US is obviously a significant share, but it doesn't mean that it's got total market dominance. And I think one of the trends that you will see here increasingly is that Netflix will be outgunned by the bigger broadcasting media groups who are now increasingly getting into streaming. So these are people like Comcast and Disney. The crucial thing here is just free cash flow. How much cash do these companies have in order to spend on their streaming services? And if you look at this, Netflix is very much outgunned, even in 2 years' time, when it comes to people like Disney and Comcast. Now, in Disney, what's quite interesting is that you have activist shareholders now calling for Disney to actually spend more on its Disney Plus service and actually take it out of dividends. You usually never hear that from activist shareholders. So I think this is going to be an important point for Netflix sort of moving forward. So that I think increasingly it's going to be in a very difficult position, particularly when it comes to the financing of production. The final point we'd make when it comes to the broadcasters is to do expect AVOD to grow in importance. Now, again, going back to the Nielsen numbers, looking at the share of streaming in the second quarter of 2020, you can see nearly a quarter there is others. If you go on the right-hand side, it gives a breakdown of that other category. You can see there that sort of in terms of AVOD's around a fifth of that other category. Now, sort of the expectation is as consumers become more hard-pressed because of growing unemployment, increasing sort of concerns over what happens with job security and also as well pressure on wages, and there will be a growing willingness to take cheaper AVOD-supported streaming services rather than necessarily pay for full subscriptions. So do expect that in terms of AVOD becomes increasingly important to the streaming environment moving forward. Thank you.